welcome up to the panel, and Jennifer and Samson as well. And I think Sarah will be joining us in a second as well. I'm going to move this cat that's working on my keyboard. Very nice to have you up. I'm sorry for background noises. I'm going to step out, and Sarah is going to take it away. Okay.
Thank you.
I was asking, did I need to do anything? And what I clearly needed to do was click the little button that said switch your microphone on. Right, I'm assuming we're good to go. So I'm Sara Hanks from CrowdCheck and CrowdCheck Law, and I'm joined by Jennifer Zepralka and Martha Legg-Miller from the SEC. And I'll let you guys, I don't know who's going to give the disclaimer. But obviously, whatever they say is their own opinions and not necessarily shared by the Commission. And I guess you can find out more about their backgrounds somewhere on the website. But just to explain how I think about what your respective roles are, I think of you as sort of like the ghost of Christmas present and the ghost of Christmas future, in that Jennifer is in charge of telling people what the rules are. This is who I go to for interpretations, for our understanding of how the rules are supposed to work. And Martha is the person I go to when I'm like, okay, I don't like the way that rule works. I'm going to look for the advocate to advocate for us to change those rules. So if you wouldn't mind, Jennifer, first just saying a few words about what your role is, what you do, and then we'll talk to Martha.
Sounds good. Let me do the official version of the disclaimer just so we're fully covered, because I'm the boring lawyer in this conversation. The views that Martha and I express today are our own and do not necessarily reflect the views of the Commission or our colleagues on the staff of the Commission. So I'm the Office Chief in the Office of Small Business Policy, which is part of the Division of Corporation Finance. Corporation Finance is the division that reviews company disclosures for the most part. It's most of the division is reviewing registration statements for public offerings, and then the periodic reports that follow from that, and also Regulation A offerings. And then my office administers the rules around Reg Crowdfunding, Reg A, and Regulation D, and then other exemptions, intrastate. But the big ones are those three. And as Sarah had said, we do the interpretations, we do rulemaking. So, we, as Martha will explain, we take input from the advocate as we're thinking about where the rules can change, but we're sort of the more, kind of traditional legal office where we are writing, interpreting, taking phone calls from the public to talk about the rules. If you have any questions about what something means, we're happy to talk to you. But it is definitely sort of the more like traditional regulator role in OSBP. Martha, do you want to?
Yeah, I feel like you're selling yourself short. The thing that she's not saying is that they're a team of people that know everything inside and out, and they write the rules in addition to just helping you know what they are. The rules that we're going to talk about today, Jennifer held the pen on and really did an incredible job with. And I get to say that as somebody that sat on the sidelines and was cheering her on the whole way, because as Sarah mentioned, we are very focused in our team on where we think the rules need to go to effectively support capital raising. So I'm Martha Miller, and I have the wonderful pleasure of leading the team that is in the Office of the Advocate for Small Business Capital Formation, which does not roll off the tongue, but it is a team focused on looking at where are there opportunities to make sure that access to capital can work better. That's it in a nutshell. We have a particular lens and focus on unique challenges that are faced by underrepresented entrepreneurs and their investors, including women, minorities, those in rural communities, and in areas affected by natural disasters. And we work closely with Jennifer's team and with others across the entire commission, because what we are looking at is holistically, how do we take the needs of companies on one hand and investors on the other, mesh those together, and make sure that our capital formation rules work well and are meeting the needs as they are in effect in that moment. And as we know, things change, markets change. People come up with new innovative ways of doing things, some of which are wonderful, some of which we scratch our heads and wonder exactly how did this innovation come about. I think that Sara has a lot of head scratching and anecdotes that she could probably use this entire session to share. What we want to do is make sure that we have got equity in the way that people go about raising equity. And with that, I will pause and let Sara dive into the questions. Did I give an okay overview of what we're doing as the ghost of Christmas future?
That's great. And one of our sort of early Christmas presents, I guess, is your annual report. And part of your responsibilities, Martha, is putting together the annual report, which I think is mandated by Congress, right?
It is.
And so tell us about what the most recent report is, maybe where people can find it, and what's going to happen in the next annual report. What are you looking for to put together next?
Yeah, so that's, as you mentioned, Congress asked us to write a report. Congress actually created our office, and we are in our second and a half year of operation. So we started in January 2019, and Congress created us as an independent office that was supposed to advocate for solutions to the challenges faced in our capital markets. And they asked us to send them a report. And there's lots of reports that different agencies send over, and most of them are Times New Roman. And the big decision is, do you do it one column or do you go with two columns? And that's about as exciting of decisions as a lot of people think about it. And we thought, do you know what? If we're sending something over, let's send over something that is really impactful. That was our goal. We wanted to send something that gave really good intelligence on what's happening in the market and helped to validate what we are hearing as stories in the market with the data. So what we did is we took data that we have internally from our economists, and then we paired that together with data from people across the market. So whether academics, whether different thought leaders, news sources, and what we wanted to do was weave together a tapestry of how capital is being raised from the very earliest stages all the way across the market. And I have to say I'm biased, obviously, you can tell, but I love it because I think that it really does a good job of helping our policymakers, both within the commission as well as on the Hill, understand not just the stories that they hear, but what the magnitude of that impact is. So if you go to our website, and one of my colleagues, Jenny Regal, has beaten me to it. She dropped a link in the chat for those that are able to click over there. There's a copy of the most recent report that we sent over, and you'll see in there there's a number of data sources on what's happening with crowdfunding. For instance, we highlighted in there the spike in crowdfunding offerings in the summer of this past year that was really a measurable increase in offering proceeds compared to what we saw over the entire first year of capital raising. So I think you'll find things in there that are really interesting from the crowdfunding perspective, as well as Reg A and the different other offering pathways. But what we really wanted to do, Sara, was to take the mandatory report that we were going to send over and really use it to elevate the conversation and contextualize it. And it has been a wonderful launching pad for conversations.
Well, thanks. And one thing I should point out, and I'm going to point this out throughout, is just the amount of resources that people can find on the website, the SEC's website in general, on the advocates' website, and also in CorpFin. And we'll get into some of these sort of interps and things later. You had mentioned Jenny; she's the star of some of the videos you've been putting out. People should go to the website and go look at some of those videos, because this is a new way of sharing information. You know, I'm used to, as being a lawyer, looking through pages and pages and pages and drilling down to the footnotes. This is a very non-footnote way of communication, which I think should be praised. And to build on one of the things that you just said, I mean, the crowdfunding market has increased exponentially almost since the pandemic. I think everybody, they baked all the sourdough bread, they made the TikTok videos, and then they're like, oh, what shall I do now? I'll invest in startups. Well, that's going to last a lot longer than the bread, probably, and certainly longer than the TikTok videos. But coinciding with that growth, we've also had the changes that went into effect, adopted in November, went into effect in January. And the changes to Regulation CF, which we'll talk about first, include, as I think was mentioned this morning by Doug Elenoff, among other people, bumping up the overall investment, the overall offering amount from 1 million to 5, changing the investment limits so that accredited investors don't have limits, permitting the use of special purpose vehicles, and permitting the use of testing the waters, which is the ability to communicate prior to making any filing with the SEC. And we'll drill down into some of those in a little bit more detail, and especially the testing the waters, which has taken some interesting turns. But Martha, what are you hearing about the changes? People like this? People think it's not enough? What is still out there in Reg CF?
So that's a great question. I think that people were thrilled to see changes actually come forward, because I think since the Jobs Act, people have been saying, well, I think that there's a few things that I would have done differently since the initial regs came out. So big kudos to Jennifer's team for really synthesizing comments and suggestions that really spanned across the board, from people that were really supportive and wanted to see even more changes made, all the way to people who didn't want to see changes made at all. And so I think that some of the things that we're hearing are really around kind of some of the friction points of where decisions had to be made, of where you draw lines. And so financials is one area where I think you'll hear some feedback, and there's probably been feedback shared today about where the line was drawn for what types of financials need to be provided and when. I think all of that said, people are thrilled with the ability to raise more money using crowdfunding, because where it was originally set as a cap really didn't even cover what a lot of companies are looking at for a seed round or Series A. And so this makes crowdfunding a viable tool. In addition, the changes to the limits for accredited investors, that has been something that we have heard will be very helpful for the viability of the different offerings. And so we've heard a lot of really good feedback. And I think Jennifer will cover some of the questions that have also come in where people have been looking for clarity as they interpret what their obligations are under the new rules.
So before we get to that, I just wanted to mention where you can get some information before you go bothering Jennifer. And that involves the rules themselves. Read the actual rules. They are there on the SEC's website. You can find them. If you don't understand them, that's a different issue. But that would always be a starting point. And that will actually answer one of the questions here in the Q&A. Are there any regulatory barriers to syndicating CF opportunities? Yes, the statute and the rules say one intermediary, so no syndication there. And we'll get to, there's another big question that we will get to on secondary trading, but the rules is one great place to look. The adopting release, the very, very long document whereby the SEC said, this is how things are, this is how it was proposed to change, this is what we did. There's a lot of explanation in there, and there's a lot of useful footnotes there. As a lawyer, of course, I love the footnotes. So look at the adopting release. Very significantly, there are these things called compliance and disclosure interpretations, which you find on the SEC's website under the CorpFin subsite. And there are specific interpretations as to how the rules apply, both for regulation crowdfunding. It's got its own little group of interpretations, and then for Regulation A as well. And then, as I said, all of the resources and the videos on the advocates site. That being said, Jennifer, where are the areas of uncertainty that you've been approached, and where would you like to tell people you really have to pay attention to this?
Yeah, thank you. I appreciate that opportunity. While we're talking about adopting or all those sources of info, Well, that's absolutely right. That's exactly what I would say, Sarah, about where you find things. I just want to put a little plug in for the small business section of the website, because what we've tried to do there is put all those things in one place, so that as long as you can find that small business section, which you can usually get to from the sec.gov homepage, you get in there, and then there's a little box for reg crowdfunding. And when you get in there, you'll be able to find hopefully all those reg crowdfunding things that Sarah just named, so you don't have to troll through all of sec.gov to find those interps. We try. It's not perfect, but we're trying. But there were definitely a few things in the amendments that we started hearing about right away when the rules went into effect that we've tried to make clear. And there's still more that we're going to need to do. But the first was a bit of an Edgar glitch, where the XML part of the Form C wasn't updated by the time the rules went into effect. So if someone was trying to raise more than $1.07 million, the form, when you're inputting it on Edgar, wouldn't let you include an amount over $1.07 million. We put out some guidance as quickly as we could, letting people know that we were okay with just including 1.07 million in that field, as long as the attachment where the rest of your offering disclosures were correct about what you were raising, so that we can match them up later. That is fixed now as of last week, and we updated the guidance, so hopefully anyone who's participating here has seen that. One thing to note in that guidance that we updated is that if you filed your Form C before we got that fix done, we would expect that you will use the correct amounts in the XML portion of the form if you file an amendment to the Form C at any point, so that we end up having things line up going forward. That guidance, which is on our website, also includes some information about how to fill out the XML portion of the Form C if you're relying on the new rules to use a special purpose vehicle in a crowdfunding offering. It's not necessarily intuitive if you go and try to fill in the form without looking at that guidance. So we're hoping that that will be helpful. Another thing that came up pretty quickly, and I will admit that we could have been more explicit in the adopting release, is about the financial statements required for issuers who are raising more than $1.07 million now under the new rules. The commission did not amend the financial statement requirement. So for an issuer that's raising more than $1.07 million, and this includes first-time issuers, you're required to provide audited financial statements. And that may not always be entirely clear from the way it used to work, where if you were above above 535,000, but if you were first time, you didn't have to provide those audited. This is still, if you're raising more than 1.07, you are going to have to provide audited financial statements. I'm sure there have been other questions. We do have plans to update the CDIs that Sarah mentioned and provide some other helpful guidance on how to interpret the new rules. Sometimes these things just take a while, and unfortunately, I personally can't just make the call all on my own about what we should post on the website and what we can't. So there are several levels of review that we need to go through before we can make our interpretations public. But in the meantime, and this is, Sarah mentioned this and she knows this well, we are happy to talk. If you're working on something and you're not sure, you're finding the rules confusing, call our office. We're always happy to talk to you. I know it sometimes feels weird to just pick up the phone and call the regulator. You feel like you're going to get in trouble somehow, but we really are here to help, and would love to do that.
Okay. Jennifer, one of the issues that we came up against pretty fast was when you're using special purpose vehicles, the special purpose vehicle itself needs to provide financial statements, even if it was formed a couple of days ago, and those track the same tiers. So if you're raising more than 1.07, it's got to be audited, even if you're basically auditing zero.
Yeah, that is correct. Yeah. I know that some folks think that doesn't make a whole lot of sense, but in many cases it's hopefully not going to be too hard. But there are different corporate forms, so the accounting won't necessarily be exactly the same if your vehicle is a different corporate form than the issuer. So I think we thought it was important to get the full information out there if you are using those rules.
Now, Martha, question for you on whether you're hearing anything about SPVs, because one of the another issue that has come up with SPVs is the general idea is the SPV itself must track the economic and governance rights that are given to that the company is issuing. You can't sort of take voting securities and then have the manager of the SPV do the voting. The vote the SPV manager has to reach down, find if the securities are voting, they've got to reach down to all of the beneficial owners and say, how would you vote, as opposed to substituting their own opinion here. Do you hear anything, Martha, about changes people would like to make to SPVs?
That's actually one of the big critiques that I did not mention earlier is around the SPV structure, because I think that, so when we were going about this process and looking at, okay, people want an SPV because they don't want, one of the things that we've heard from the beginning is people don't want that many individual names on a cap table, but there's also benefits to having an SPV where you could have, for example, someone who is the manager of that vehicle who can collectively act on behalf of all of those individual investors who may each own really small pieces, but can be a unifying voice. The challenge that we ran into was really striking the right balance between creating an SPV structure that worked, but not creating something that really looked more like an investment company, which is not an eligible entity for capital raising under our crowdfunding rules. And that is glossing over lots of complexity and probably hours and hours and hours of conversations that Jennifer has had and that we've had, and we got a lot of feedback on ways that people thought that we could do it. The challenge was the ways that a lot of people thought that it could be done under the rules did not jive with the ways that internally we necessarily thought actually computed with the rules and the framework that we had. And so right now there's a challenge that it doesn't work in the same way that people are used to seeing it if you were, for example, a limited partner investor in, let's say, an angel fund or a venture fund. And you basically have a general partner who is managing that fund and your interest, and they are acting in a capacity that can do things on your behalf without your action. It's just a little bit of a different structure. And so that is an area where there have been some critiques because people, I think, wanted the best of both worlds. They wanted something that looked like, you know, you could be a crowdfunding investor, but you're functioning like an LP in a fund vehicle, but this is not a fund. So that is just one of the challenges. And Jennifer, you may have additional insights that you want to share there. But I think that unfortunately what that means is that some of the people that were rallying for SPVs have then looked at it and said, but that's not the S. It's kind of like the sandwich comes out and you're like, that's not what I pictured when I ordered it. I did not know it was open-faced or hot, and that's not what I want today. But unfortunately, it's an open-faced hot sandwich, and that's what came out of the oven. That's what the kitchen is serving. And so we hope that there are ways that can be useful for some people, but we recognize that it won't be for everyone. But a lot of that is just restrictions with the ways that we were able to go about. And I say we, the collective royal we of the commission, finding the right structure. Jennifer?
Yeah, no, you're absolutely.
Probably the most
I love the sandwich analogy because if you read through the adopting release where we did this, and we worked very closely with the staff in the Division of Investment Management around it. It does sort of boil down to exactly what you were saying about it's not a fund and it can't be a fund, and so we created this definition in the Investment Company under the Investment Company Act to make it work, but it really was as far as we could get given the constraints of the statute. We know that it's not exactly what a lot of commenters wanted. I think we acknowledge that in the adopting release. But like as Martha was saying, I think we're hoping that someone will crack the code and figure out a way to make it work using the rule, and then we'll see if people adopt it. But if not, just keep telling us what's not working, and we'll keep trying.
Yeah. No, I
will say in validation of the feedback that we got that it's not exactly what people wanted. I understand the merits of having it where you can have someone who aggregates a lot of different people's perspective and actually can give you potentially more voice in governance of the underlying operating company, that makes sense. It is not that we're saying that that's not a good idea or that that doesn't have merit. It is that the rules just made that really complicated to mesh statute and regulations and the nuance there. Everything with securities law, the devil is in the details of all of it.
That's right.
Yeah, one thing that you know, my own experience, and you know, we put in letters. We were advocating the use of something that looked more like, you know, the Reg D SPV, and also that had made its way through bits of Congress, several different, you know, the House passed it several different times, and it never kind of got out of the Senate. But there had been a legislative initiative to to have a crowdfunding vehicle that looked a lot more like, you know, what people were familiar with in the Reg D context. The testing the waters is another area that we've seen some kind of interesting issues evolve here. It has to be clear when you are testing the waters, it has to be very, very clear that you are testing the waters, that you are not actually taking investments at this time. But what we've seen with the actual substance of the testing the waters provisions, the evolution has gone very much like Reg A, testing the waters, where originally everyone was like, well, you could do a very limited communication to see if people would be interested. And it basically evolved into pre-filing marketing. And we're seeing exactly the same thing happening with testing the waters for Reg CF. But I think one of the things that has become obvious, Jennifer, is it's not always clear what stage that the issuer is in, and people think that they're starting to invest, and that the communication that you are not yet raising, I think, really has to be emphasized, right?
Yeah, I think that's right, and I'm glad you brought that up because it's something that we have been paying attention to. It's you know, and I shouldn't say this out loud, but I'll admit, like I didn't anticipate that testing the waters would be happening on the funding portals. You know, and I should have anticipated that, and I didn't. So I was a little bit surprised when this first started, and like suddenly all the funding portals are hosting testing the waters. It's fine, not prohibited, so I'm not trying to scare people off from doing that. But it is something that I'm hoping that the market can work with us on. Yeah, I'd like to kind of just make a pitch there about if you're a funding portal and you are hosting issuers testing the waters, we need to make sure that it's clear from the user or the investor perspective that the offerings do not yet have a Form C on file and are not yet open for investment. You know, it's there's a variety of practice that I think we have noticed. We'd really like to see the use of different terminology at the testing the water stage. Not something that looks exactly the same as a campaign page, and when you click on it, you know, and there's a link to go invest, even though that you're not taking investments yet. I think that there's some potential investor confusion here, and also to make sure that the legends, the testing the waters legends that are required by the rule, are clearly available to people who are expressing interest. So that's just, you know, not calling out anybody in particular. It would just be really great if you know, if everyone could sort of take a step back and look at that and see if it's clear enough to the investors what exactly they're doing when they express interest in a testing the waters campaign.
Thanks. And one of the things that I think was mentioned in the adopting release is material misstatements made in the testing the waters. That's part of that, you know, you are responsible. The issuer is responsible for any material misstatements. And to the extent that the intermediary is liable for those statements, which I know is a matter of debate in any case. But if the issuer is responsible for them, they're responsible for them, whether it's TTW or whether it's the actual live offering.
That's right. We were clear in the release that these communications are offers of securities, even if you haven't filed your Form C yet. And so all the the whole menu of rules that apply to the funding portal as a gatekeeper will apply here as well.
Yeah. Yeah, there's an interesting thing that I think we'll circle back to later, which is because you said that you didn't think that it would be the intermediaries who'd be hosting the TTW. To the extent there are other agencies or there are other entities that are willing to host testing the waters, those guys had better also be aware of their responsibilities, possibly as broker-dealers, and we'll circle back to that later. It's kind of it's an interesting area, and it's been, as I said, very interesting to see the TTW for CF track the trajectory that, because people now in Reg A, they'll say, well, we're not doing testing the waters, we're doing a reservation period. Like, it's the same thing.
Right.
Bear in mind that under both exemptions, the TTW materials gets filed with the SEC so they can see what you've been saying. And also another flag is the whole idea of if you say something in your TTW that turns out not to be correct, you need to go back and correct it using the same channel of communications that you said the inaccurate thing in the first place.
That's right.
So one thing I just wanted to get into is, where are you seeing mistakes with respect to compliance, not just with the new rules, but with the existing rules? Is there anything that you'd like to draw everybody's attention to, things that they should be really paying attention to?
So I do have some on Regulation A, which I think we'll get to in a little bit. Sticking with crowdfunding, I don't think there's been, other than the things we've already talked about, I'm not sure there's been too much confusion around the new rules. Just generally, just to focus on making sure you have the right financial statements, the right level of financial statements in the filings. We do see those. Sometimes we'll pick one up and notice that, the first filing didn't have financial statements in it at all. That temporary relief that let you do that has now expired. So if you're still doing that, that shouldn't be happening. It's, but it's mostly just sort of a focus on making sure that you really are going through the rules and providing disclosure on every point that's required. I don't have anything particular other than the testing the waters thing we just talked about, and some of those other things. I don't know.
Yeah, the thing that I would flag is not really a mistake in as much as an area, I'll call it a growth opportunity, a room for improvement. If this were a performance review, an area where we could see some wonderful growth would be in how the economics are described to investors. When we do hear critiques, one of the things that we hear is that language or jargon gets recycled and copied over without somebody necessarily understanding exactly what those rights and preferences look like for investors and how that will work in reality. And so I think it's just critically important to make sure that if you are trying to employ particularly more of a complex security, not something that is just more of a straightforward preferred stock type of issuance, that you really understand as an issuer what you are selling and that you are explaining it in very clear terms to investors. And I think as portals, making sure that you're working with the companies to provide very quality and consistent explanations of what investors are purchasing, because it is a terrible reputational hit when you have investors who don't understand what they purchased and are unhappy with it later as a result of disclosure. Sarah, I know that's something that you probably have thoughts on and you've shared different feedback on with us, but that's just an area where I would encourage people to pay more attention in the future.
Yeah, and we've pointed it out in the past, and there are some instruments where if X doesn't happen, you get nothing. And if the portals would just say that, you will only get anything back if one of the following two things occurs. And it seems to be extraordinarily hard for anybody to actually put that down in writing. And yet that's where some of the instruments that are being sold are actually that's the economic reality of those instruments.
I'm glad that you brought
that
that up. Yeah, because the commission proposed to restrict the types of securities that could be sold under crowdfunding and didn't end up adopting that rule change. But I think there's some, in deciding that, maybe we didn't need to change that at this point. I think we tried to make it clear that we wanted to see really clear disclosure about the terms of securities that are not necessarily vanilla debt or equity, because I think that is pretty common, that investors aren't quite sure what they're getting.
I think that's a really good point, and would really emphasize words of one syllable. It is easy to explain these things. If this doesn't happen, you get squat. Yeah. Anyway, so moving on to some of the other issues. That there was just one of the things that we're noticing, Jennifer, is that some of the more complex things, like what we call the issuer aggregation rule, the fact that if a company is under common control with another company, that counts as excuse me, one issuer. And control is, under securities law, a much broader concept than regular people think. It could be 10% share ownership. It could be a single board seat. So if you're a VC who has 9.9% of a class of equity, and you have a board seat in company A, and then you also have a board seat in company B, those guys are under common control and they are subject to the $5 million limit. And I just wonder, is there a way of making that and some of the other, more intricate securities law, more obvious to issuers? Because when we get involved, it's always a really unpleasant surprise when we say, nope, your sister company used up all the 5 million. You can't do it.
Yeah, I mean, it's a good thought. I mean, I think, as we're thinking about additional guidance and more sort of plain English guidance around this space, I mean, just to backtrack, these rules got put together reasonably quickly. I know everyone thought it took the commission a really long time, but we got the statute. We had to write the rules. It was a whole new framework, and we're securities lawyers, so a lot of it does refer back to other parts of the rules. Things like the definition of control. But I think you're right that people do get not caught up by it, but there are questions, and there's some level of almost sophistication sort of assumed in the rules that we probably could benefit from making it more clear. I appreciate that comment.
So I thought we'd move on to Regulation A, and then we can talk about secondary trading. And I see there's quite a few questions on the secondary trading issue. So Regulation A, the changes were less complex. Basically the increase to a maximum offering amount of 75 million. And then the one thing I would like to flag about Reg A is, as Jennifer knows, we've had so many clients who are doing a 506B, a 506C, a Reg S, a Reg A, and a Reg CF all at the same time. And so having changes to the integration rules to make them simpler was a complete blessing to us. You've got to wonder why some of our clients do that, but there's really, really good reasons. But the integration rules are the rules that say if you've got more than one offering going on at the same time or close in time, under certain circumstances, they will be treated as being the same role and because the same offering. And because the rules apply differently, you could be, well, you're allowed to do this kind of communication for this one and not for the other one. That has been made much, much simpler, which we are truly appreciative of. So that's one of the big things with Reg A. But Jennifer, anything that you want to flag in Reg A, either new rules, old rules?
Yeah, I did have a few things that I wanted to mention just because I'm seeing a couple sort of compliance mini trends. It's not so much under the new rules because we didn't make massive changes there other than raising the offering cap. We tried to make a few small tweaks to try to make it work a little more smoothly. Like you can now incorporate by reference previously filed financial statements into your offerings statement. That's that should be a bit of a time saver, but it's not full forward-looking incorporation by reference. It's not like you get to work it, use like an S3 model where you file your registration statement and then it automatically updates every time you file your 10K. That's not how this works. You still have to, if you're doing a continuous offering for more than a year, you're going to need to amend your offering statement to include your new financials. The fact that you filed them in your 1K isn't going to get them into your offering statement. I've seen, this is sort of a little mini trend of several issuers who are kind of forgetting about their post-qualifying amendment requirement here. And we'd like people to try to pay more attention to that. And then the flip side of that, we're also seeing a fair number of tier 2 issuers who are not filing their 1K as required. And so we'd like people to just sort of, I'm mentioning it now to hope that maybe people are listening and we'll get a little bit more discipline in this space. But those are two things I wanted to note. There's also another thing that you might miss in the rules. If you're doing a continuous offering, there's a 3-year expiration on that offering statement. So when you're hitting 3 years, you need to replace it. It doesn't go on forever without a replacement. So, and those post-qualification amendments you do every year to update it, that doesn't count. Like you have to actually replace with a new 1A. Also, we've seen issuers who choose to put a time limit on their offerings. So leaving aside the 3-year expiration, you might launch your offering saying we're going to run this offering for a year. But then you'll decide to extend their offering later. We would generally expect to see you amend before the termination date to tell your investors that you're extending it past a year because they've been relying on you telling them that's only going to go on for a year. So if you don't do that, you might get some comments from the staff questioning whether you need a new 1A to start a new offering because you let it expire by its terms. And then another one that Sarah's seen a lot and which sort of ties into what we were talking about for Reg crowdfunding with the affiliated issuers. We continue to see lots of affiliated issuers in the Reg A space. Reg A is not drafted the same way as crowdfunding, so it's not prohibited. But it is something that we look at pretty carefully when we see an entity or a sponsor that's creating multiple subsidiaries or entities that are each doing their own Reg A offering. If you do that, don't be surprised if you get some questions from the staff about why those entities shouldn't be considered one issuer or aggregated together for the purposes of the $75 million Reg A offering cap. It's a very heavy facts and circumstances analysis and one that I hope we can give more guidance on in the future, but it is something that is lurking out there.
Thanks. And yeah, we've been on the receiving end of those comments sometimes. And the one thing I wanted to emphasize here is that the magic is unique investment opportunity. They do have to be unique. And just saying this company does it in the South and this company does it in the North is not unique enough for the staff. So that's, I mean, it's a learning experience for all of us. One of the big things with Reg A especially, but also I see the question coming up in Reg CF is secondary trading. Just to emphasize here, Reg CF and Reg A are exemptions from registration for the issuer, not for resales. As I used to teach my first year securities lawyers when I was in a law firm, everything is either registered, exempt, or illegal. Every transaction in securities is one of those three. And so the exemption that is usually used for secondary trading is Section 4A1 of the Securities Act. We're getting into too much nitty-gritty there, but people say, well, what's the exemptions that's used for trading on the New York Stock Exchange? I mean, there is a federal exemption, and then there is preemption of state securities laws, because you've got to comply with the registered, exempt, or illegal structure at both the federal and the state level. So for Regulation A and Regulation CF, those securities do not get the state preemption. You've got to comply when you're doing secondary trading, not just with the federal exemption, but also with the states. And some of that can be, very complex. Gets to be very expensive. There's various exemptions. You can get things into a securities manual, which is something that CrowdCheck does. You can look at the isolated transactions. Some of these states have sort of 15C to 11 equivalents. There's a lot of different exemptions, but there's no overriding federal exemption or preemption of state law, which means it's difficult to do secondary trading without going through all of those hoops. One of the things that was raised in the 2019 concept release was, would you be interested in state preemption of state secondary trading laws? And everybody's like, yes, we would. We would very much be interested. Please do that. Disappointingly, that did not happen in the recent round of changes. Is there any chance that might be looked at again? We've got several questions here along those lines. Does anyone want to handicap the possibility of state preemption of secondary trading being looked at in the near future?
Well, I won't quote Dumb and Dumber, it's a 1 in a million, so you're telling me there's a chance. But what I will say is that, I said I won't quote it, and then there I did, I quoted Dumb and Dumber in an event. But I think that the challenge there is there's a valid role that states play, and particularly the state regulators very much push back on this because of concerns about losing the ability to stay on top of things that are happening in their backyard. And so I think that when we're looking at matters of preemption, and Jennifer may have a different perspective that she wants to share on it, it's a really fraught political issue. That's the really candid answer, because what you're doing is you're saying that one party's regulatory regime gets to effectively supersede another one. And so it's a strange place for the commission to be. It's different when Congress says, all right, we're going to pick and choose who gets to regulate. But when you have one regulator saying, we're going to pick to regulate and tell you you can't, that's just a very different environment. And that's a really hard call, I think, for any commission of any political composition to make, because there's a lot of pushback that you see there. Even when there are valid reasons to do it, even when there would be efficiencies for it. So one of the things, Sarah, that I am really interested in, and this is, again, we've given the lovely disclaimer that we're speaking for ourselves. I give like the bonus, I'm going to reiterate the disclaimer that I'm thinking for myself here, because one of the things that I think would be really beneficial is if we can look at where are there inefficiencies within different regulatory processes where you are doing the same thing on repeat, but in every different state, where we could have more collaboration through centralized single portals. That would be, this is not something that I would see the SEC pushing down on anybody, but more of a collaborative. We've seen it in certain pockets where there have been test examples of it, but I don't think that we have enough of it. We hear a lot about it in the smaller fund space, where they just have a lot of trouble, where they're filing the same thing but on a different form and filling out functionally the same paperwork, but sometimes 50 times. And that's not the best use of your compliance dollars. They should go towards, I think, other really good costs, or towards operations instead of compliance, if it's going to achieve the same end objective. So that's not a satisfying answer for those who are hoping to hear me slip up and say that that's on the docket, and then say, oops, that's non-public. Unfortunately, I don't know when and if that is something that will get traction. I certainly see the merits of it. And I've seen it from being in practice, that it can be really frustrating to have a whole lot of different people weighing in on what you view as a singular filing. But there are political realities behind it that make it where I think that that's just a very challenging call to see the commission make independently of Congress.
Point taken on the most useful thing that we could all do as a community is make the same filings exactly the same. If there is a requirement at the state level, it would be really great if Tennessee could be the same as Kentucky. Whether it's for the state resale provisions, or whether it's for Reg A notice provisions, because there are all of these little tiny differences among the states. So yeah, we'd be behind that one. One thing I wanted to get into before we try and finish up some of the Q&A is the use of finders and brokers, because this is becoming kind of a very interesting question for small companies on a number of different levels. For just as a bit of background, if somebody acts as a broker-dealer, which is affecting securities transactions for the benefit of others and being in the business of doing that, then they need to register as a broker-dealer. For many years, the legal community has asked for guidance on what it means to be in the business, and for many years has not gotten much guidance. However, I wanted to flag for everybody the November, I think it was, Finder's proposal that came out that said, under certain circumstances, people, not companies, but human beings who put potential issuers together with potential investors, under those circumstances, they might be able, if they comply with these proposed conditions, they might be able to not be treated as finders. Now, I have no idea where that's going to go under the present leadership, not asking you for any comments on that, but I just wanted to flag it because it's really important to look at what was said in that release. Look at page 12 and 13 in that release with respect to the role that solicitation plays in somebody's broker-dealer status, because all of us for many years have been really focused on, are you getting transaction-based compensation? It's never been the only criterion for whether somebody was a broker-dealer, but it was always a very important one. And now clearly the staff is looking at that solicitation role. So one thing I would urge is for all people who are not broker-dealers to look at whether their activity is in fact something that might raise broker-dealer registration concerns. And Jennifer, from the point of view of people, companies that use non-broker platforms, intermediaries, portals, whatever we want to call them, what's the risk there?
Yeah, so it's these are always very facts. I can say there, because I don't want to, with a broad brush, paint all finders and platforms and everything in one stroke. But this is one of those areas where I think probably the best advice is to talk to experienced securities counsel if you're a small company and you're planning to work with one of these platforms or a finder or something similar. There can be consequences for the issuer if it turns out that the person or entity that you're working with should have been registered as a broker-dealer, and that can be pretty bad, like up to the possibility of rescission rights for investors or enforcement action. So I think that you just want to proceed with caution, talk to someone who can help you work through exactly what Sarah was just describing in that finder's proposal, in some of the other guidance that's out there, and see if you can get comfortable before you do it.
Okay, thanks. As just going on to some of the Q&A question, because there's some very interesting questions here. There's one of the questions is on exactly this topic, the operating as an investment listing service as opposed to a CF portal, connecting investors with investment opportunities. Yep, as Jennifer just said, get some advice, see if that activity triggers broker-dealer registration concerns. There's a question with respect to would the 5 million go up at some point? Anybody want to predict that one?
I think that is one that time will bear out. But since we just got to 5 million, I think that this is the time to work with that as the limit for the foreseeable future. And at some point, we may see limits be adjusted again. But I don't think that is, if I'm a guessing person, that's not a 2021 agenda item to be looking for.
All right. Very interesting question here from the Midwest. Comment on the SEC's ability to offer a no action letter to permit a Reg CF portal to raise funds for itself on its own platform. Because of course we've seen a couple of platforms, since you can't raise funds for something you have a financial interest in, and you clearly have a financial interest in your own platform. Platforms raising funds for themselves have had to go on to other platforms. Is that something that the staff might consider a no action letter for?
Well, you don't have any trading and markets people on the line, so I shouldn't speak for them. It seems challenging given the requirement to be able to interpret that, to say that it would be compliant seems challenging to me as a corp fin person. But you know, it's something you could call them up and ask about.
Yeah, call trading and markets and ask them if they'd listen to that one.
And I'll say that is a good example of an area where you spot something where the thing that people, I think, often lose in the mix is that portals are generally small businesses, and most of them, because, you know, this is a relatively new industry, have had to raise capital in recent years and are still needing it to really build out and operationalize. So to the extent that you spot something and you think this is really hampering our ability to operate because of the capital raising rules, reach out to us. We're happy to connect you with the trading and markets team. We're also happy to help just vet some of the questions that you might have for a future ideal state where you think there is a different way that the rules ought to work. But agreed, it is a little bit of a thorny an issue there, but the trading and markets team is really wonderful and would be happy, I think, to work with you on coming to an answer.
Okay, thanks. And just one question to wind up is question raised about the requirements in the Jobs Act with respect to outreach. This is one for you, Martha. Can you talk just briefly about the outreach that I know you have been doing across the country?
Yeah, so one of the things that I think is really important and is that we're a team of advocates, but that means that we are advocating for other people. We're not advocating for our own use of the capital rules. We're advocating for them to work better for you, and for us to do a good job of that requires us to be in regular touch with people that are using our capital raising rules, and to hear the feedback and to do a good job of communicating your story. And so we're very passionate about doing outreach and engagement. If you have ideas or places that you think that we need to be, if you have just now figured out that we exist today for the first time, come talk to us. Tell us how we can get in front of other people that we should hear from. And if you have ideas, you're welcome to also come and not in person right now, but have a virtual meeting with us and share your perspective, because for us to do a really good job, and for Jennifer's team, when they're writing rules, to do a good job of making sure the rules work for you, we need to hear from you. The last thing you want is for us to sit in a little glass building in DC and come up with rules without talking to the market, which is not to say that's what we're doing, what's ever been done, but it is critically important that we hear from those who are using the rules. So we thoroughly enjoy the outreach and engagement part of our mission, because it is really fun to hear about the wonderful things that people are doing.
I really appreciate that. Jennifer, anything that you wanted to add about your office and people coming? Because you guys are really great at answering questions, and we really appreciate it.
Thank you. Yeah, I mean, as I mentioned earlier, we're always happy to help. If you go on the website, we have a web intake form where you can send us your question in writing, or you can call us up. One of the great people in my office will always call you back, and we're happy to talk through things. Or if you find Martha's office first and it's actually an interpretive question, she'll get it over to me, and we will happily answer you that way. Don't worry about exactly where you come in, because it'll get to the right place. And I just want to say
we talk
again,
to each other often,
all the time.
Really
Right. That's what I was just gonna say. Like, just to make it clear, like our missions are so similar. With like mine's a little more legal bent and hers is a little more advocacy, but like we talk constantly, we share information all the time, and so if you find one of us, you can talk to both of us, and it'll be great. So thank you.
Oh, great. I don't know if Peter's going to take over from us now. It looks like he is. There he is.
Hi.
Thank you very much, both Jennifer and Martha. Thank you.
Thank you, Sarah.
Thank you, Peter, and everyone for the invitation to join you today. This was a lot of fun.
We really
Wonderful
appreciate
conversation. Thank you very much.
Thank you.
Much of it over my head, but very interesting to learn about kind of the processes of how ACC works. And esteemed speakers, it comes, at least a couple of words I'll pick up from there. Thanks a lot. Folks, well, at this point, we're going to have another break, and then it will be followed up by Brian Christie's presentation of the overview of the crowdfunding ecosystem. And then we're going to veer off into two separate tracks, one on international panels on crowdfunding, and another more on the blockchain side and crypto investing, things like that. So stick around, meet new people, and note that after those two tracks, we're going to have another keynote presentation by Woody Nice. And the conference will be, the official part of the conference will be then closed off by Maureen Murad, our Legislative Affairs Chair, and then we're going to have a after party of sorts. So stick around, there's going to be interesting conversations. I'm looking forward to meeting all of you during the after party.